try to hit just a little bit of chapter 2 here. We'll go through it all, but I want to go through it kind of quickly. There's just some terminology and some things in here that I want you guys to know and know well, because we're going to go over a lot of it throughout the whole semester. You know, there's some of these terms that are just going to come up that we're going to use and reuse and talk about, and I want to make sure that you guys know them and understand them, and you talk of them off the top of your head, maybe, just like I tend to do a little bit, because it's truly things that finance is all about. So get this going here. So kind of three main statements, you know, and we're going to spend a lot of time probably on all three of these. The income statement, that's usually over a period of time, right? So we want to have our income statement for the last month, maybe the last quarter, maybe the last year. We get, if you go publicly and you look at public companies, they have to report every quarter, okay? So publicly traded companies, Apple, Microsoft, Facebook, General Electric, General Motors, whatever, Cummins Engines, they all have to report every quarter. Okay, that's an SEC requirement, or Securities and Exchange. And so we can get those too, right? They have to report them. Usually they got about a month or two after, a month or so after the quarter ends to get their reports in. And then we can look at them and see how they're doing. So balance sheet is something that's a point in time. Here's where we're sitting at this particular point in time. And then a statement of cash flows kind of takes a lot of stuff from the income statement. The simple way of figuring cash flow is you add back in some things that, because there are expenses like depreciation that are not cash expenses. It gets a little more complicated than that in a real cash flow, but that kind of gives you an idea. Some of that has to do with the method of, if you're doing a cash method or an accrual method of accounting. The income statement, yeah, we measure profitability. Our sales, right? And sales will oftentimes also be referred to as revenue. Okay, so you'll see revenue or sales, they're pretty interchangeable. You can argue sometimes that you can get some money in that's not actually sales. If you sold a piece of equipment, for example, you know, that might be counted as revenue then and not actually as sales, because it's not a part of what you normally sell. That's, you're just getting rid of old equipment or something, right? Okay. Sales minus cost of goods sold is equal to your gross profit. Okay. Gross profit as opposed to net profit, which is then after we subtract out our expenses, which we'll see here in a little bit. So remember I told you Costco, you know, their gross profit's right at 13%. Basically everything they sell has got about a 13% markup on it. It's kind of interesting looking at their financial statements, their income statements. So gross profit minus expenses, right, equals earnings before income, before interest and taxes, or EBIT, earnings before interest and taxes. It can also be called your operating income. Very common. These are common terms that we're going to be using. And then EBIT minus interest is your earnings before taxes, and of course then we take off the taxes and we have our net income in that case, right? Very simple, okay? I mean, it looks very simple, and it is very simple. Obviously, some of these categories can get to be a little expanded, and you get some different things in there, and you know, what counts as an expense, and are we doing accrual versus cash accounting, those types of things. And I'll try to give you some examples on those in a bit. So it's kind of computer.com, we call them computer companies. I mean, they were famous or maybe even infamous for going years and years and years without ever showing a profit. If you went back and looked at Amazon up until 7, 8 years ago, Amazon was a huge company, but guess what? They never showed a profit till maybe 7 or 8 years ago, something like that. I may have my time off a little bit because when you get older, you lose perspective on time, but they were simply reinvesting dollars back into the company in a huge way. Every dollar that came in, they were reinvesting it, and thus that created expenses, right? So they didn't show profits, and yet the company was growing just by leaps and bounds, okay? Now for the last several years, they've been, you know, they've kind of become a profitable company, and you could sure look at their income statement and see that. return on capital, that's a huge thing, right? That's our, if we're investing money in a company, the return on capital, that's kind of, what we're getting, right? In this case, they're talking about capital investment, I'm sorry. So the different types of capital, or the different ways companies raise capital, right, is one, they can sell bonds. Borrow money is what they're doing when they sell bonds, right? Okay, companies borrow money. They don't always go to the bank like you or I might, okay? They issue bonds. Big companies issue bonds. Okay? Sometimes they go to the bank still, okay? Big banks and big companies, they make special arrangements and whatnot. Especially they'll make a lot of arrangements on short-term lending, kind of like farmers do, right? We got farmers and ranchers in our area that, they need an operating line because they got seed in the spring, they harvest in the fall, boom, they pay it back. And companies will still oftentimes set up those kinds of arrangements with banks because it's a lot more convenient than trying to issue some bonds in June and paying them off in September or whatever the case may be. Preferred is not real common, okay? Preferred stockholders or preferred issues are not real common. Okay, and the reason for that is they're really advantageous to the owner of the preferred stock, but they're really disadvantageous to the company that's issuing preferred stock. Okay, oftentimes you'll see preferred stock offered in special arrangements. When we had the financial crisis in 2007, 2008, something like that, Goldman Sachs wanted to raise some money, and they called Warren Buffett. They said, hey, we'd like to raise some money. We want to shore up our balance sheet a little bit. How about lending us some? And he said, well, how about a preferred share? You guys give me some preferred stock. And I think it was $5 billion or something like that. And they made that arrangement. It wasn't Warren personally. It was Berkshire Hathaway, the company that he runs, right? And he actually did that, I think, for 2 or 3 companies at that time because the way things were going, and banks especially were underwater because of the mortgage-backed securities and whatnot. So he made those kinds of arrangements, I think, with a couple of different, obviously very advantageous for him. Okay, common stockholders are the things that we normally see. Okay, when we talk about a stock price, we're looking up what Apple stock price is today. About 160 bucks, somewhere in that neighborhood. That's a common share. That's per common share. Preferred don't have separate listings. Mostly because most companies don't issue any preferred stock. Earnings per share, important number, okay? So that's how much money you're making for every share that I own, right? That's really kind of important if I'm a shareholder, and how fast you're growing the company is another thing that's really important to me. A lot of these we'll talk about more as we get moving along through some of these chapters. Statement of retained earnings. That's what the actual capital then of the company is. The net worth, I should say, of the company has to do with the statement of retained earnings, along with the initial. Of course, you got to talk about the initial holdings too. PE ratio, we'll talk a lot about in the second half. Not a whole lot, but this has the price to earnings ratio. So what's the price of the company? If Apple's at 160 and Apple earns $16 a share, they don't earn that much. Okay, their price to earnings is 10, right? Price is 160, earnings are 16, so their price to earnings is 10. That would be a really low number. The average right now for the S&P, the average S&P company listed on the Standard & Poor's Index is about 18, I think it's been running, 17, 18, okay? And so 10 would be really low. 10 would be a number you might see with like a utility company. Their earnings and revenues tend to be fairly stable, so sometimes they have a lot lower price to earnings. Fast-growing companies tend to have very high price to earnings ratios. Okay? I don't know if I can think of any off the top of my head that are really considered very fast-growing right now. Generally, some smaller companies that are up and coming. You guys might have even a better handle on that than I would. In the past, companies, when Facebook first came out, and Snap, and those types of companies, for a long time, they had very high price to earnings. Go back to, I told you Amazon for years didn't even show any income, right? I mean, you couldn't even calculate price to earnings because they didn't show any earnings, right? Didn't mean it was a bad company, obviously. It just meant that they were putting all their money back into the stock or back into the company. it can kind of give you a little bit of an apples to apples comparison. Again, fast-growing companies are gonna tend to have high-priced earnings. Slower-growing companies will tend to have lower-priced earnings. That's some old comparisons. Think how old those are. We could look at some. If we get a chance, we'll take a look at a few. Limitations of income statement. Sometimes you can have extraordinary items that can really screw things up. Also, I would tell you that in some cases, a lot of cases, the SEC changes the way rules and whatnot are made or enforced or enacted, and so it creates some weird things. Berkshire Hathaway, again, I know I talk too much about them, but they're a major holder of other companies. You know, they're the biggest shareholder in Apple, and they're the biggest shareholder in Wells Fargo. They changed the accounting rules here just in the last year or so. So if Apple stock goes way up one quarter, Berkshire has to show that as a profit. Okay, even though it's an unrealized profit, they're not going to sell their Apple shares. They're going to hang on to them, right? They still have to show that as a profit. That's an accrual basis of accounting, that they have to show that as a profit, even though they have no intention of selling those stocks anytime in the near future. Likewise, if the stock goes way down one quarter, then Berkshire has to show that as a loss on their financial statements. And so it's kind of, you know, it can be a little bit deceptive. That's why if you go back, if you're following Berkshire Hathaway, what do you really want to look at is their operating income. Go back to their operating income, because this stuff's all extraordinary. It shows up in a little different category. If you go back to their operating income, then you see how the companies that they actually own and the income that they actually bring in, how they're actually doing. Flexibility in reporting, yeah, it can get a little bit odd sometimes. I'll give you another example. Car companies, right? Car companies know that every car that they make, there's 5%, they're gonna have recalls that equal about 5% on into the future, right? Okay. The SEC requires that they show that 5% loss the day they sell the car. Okay. And yet the IRS doesn't allow them to show that loss until the loss is actually incurred. And so they actually have two different financing statements going on, what they have to report to the SEC, and then also what they actually report and pay their taxes on to the IRS. That can make for some confusion at times, okay? And you guys might see some of that when you do your reports in the second half. So, balance sheet again, assets versus liabilities. It's basically it, right? It's got a balance, right? Assets are on the left-hand side, liabilities and net worth on the right-hand side. Net or owner's equity is probably what it's most often referred to. I'll say net worth. Net worth and owner's equity are pretty much the same, right? They count their assets in order of liquidity. What can be turned into cash the fastest? Cash is obviously number one. Current assets would be short-term investments, okay, those types of things. You might have some government bonds, those types of things on your books. Inventory is considered a short-term asset, different things like that. Marketable securities, that's the short-term ones, right? Accounts receivable are generally considered short-term assets. You might not get paid right away, but you can usually convert accounts receivable if you want to. You could take accounts receivable to a bank and they'd give you the money, basically, and then they could collect it. Inventory, prepaid expenses, right? Investments, yeah, no. I mean, most investments, yeah, you can convert. They list these a little bit separately because you might buy a bond that's got a 5-year maturity. Okay, so that's considered an investment. Generally, you could sell that bond tomorrow if you wanted to. Okay, you could call your broker and say, I want to get rid of that bond. Your broker would get rid of it in a heartbeat, probably while you're still on the phone. Okay, but they're still considered a long-term investment because they do have that 5-year maturity date. Plant and equipment then are fixed assets, right? So remember, we're going to have current assets, fixed assets that we're going to talk a lot about when we get into that. Total assets then, right? And then you got the liability side. Again, you classify things by order of maturity, I guess. So shorter term stuff shows up at the top. Current liabilities, we'd call those. Accounts payable, of course, notes payable, current portion of long-term debt, you know, the payments that you have to make in the next year on a long-term debt, accrued expenses. And then you get to the bottom and you got the equity portion. Preferred stock, not real common stock. Capital paid in excess of par, that's kind of an oddball thing. It sure screws you up sometimes when you're looking at financial statements because, companies issue stock and those little stock certificates will have a par value on them. It might say like $2, $5, $10, whatever. But when that stock goes public, people might actually pay $100 or $200 per share for that. Okay, it's still considered they got a par value, and then they've got this separate category that in excess of par value, capital in excess of par value. It's a little bit odd, but they ought to just not have a par value on the stocks, and would be my opinion, but oh well. And then retained earnings, right? From year to year, if you make money and you keep it, you don't pay it out in dividends, or you don't buy back stock, or you don't do other things with it like that, then it becomes retained earnings. Then you've got the net worth of the owner's equity, right? Which is assets minus liabilities. It's called the accounting equation, right? The accounting equation is assets minus liabilities equals owner's equity, okay? We get this difference between market value, though, and book value, and this will create some confusion at times. The market value of Apple, I think, is approaching $2 trillion, if I'm not mistaken, okay? The book value of Apple's maybe a couple $100 billion. I'm not even sure. It's probably at least that much because they got a lot of cash. Maybe, let's call it $500 billion, okay? So what's the difference? Why can it be a market value of $2 trillion and a book value of only maybe $500 billion? Okay? Well, the market value is what people are willing to pay for, right? And they're willing to pay, as shareholders, we're willing to pay for that based on what we expect Apple's earnings to be in the future, okay? And so that creates a market value, which is most often completely different than the book value, most often, okay? Sometimes the company's going the other way too, and it can be the opposite. Sometimes the book value. Yeah, Bridger, question? No, no. The book value is what the company would be worth if they liquidated, conceivably, okay? That's the book value. The book value is the accounting value. That's what the accountants do. They have to prepare that, okay? The market value is just simply what people think it's worth, okay? Based on, again, you're usually basing that on your expectation of earnings into the future earnings, okay? So the two are very, and we can take a look, maybe I'll whip through this, try to, and we'll take a look at like Apple or some other company and see what the difference is in market value and book value. Some limitations of the balance sheet. Some of those things we talked about, some of those accrual things, where you've got to, from the SEC standpoint, right, you've got to show future potential losses, but you've got to take those now, and some of those things can be a little bit weird. And I also talked about the mark-to-market. That's when each quarter Berkshire Hathaway has to mark-to-market what the value of their investments are, and that could wildly fluctuate depending on what the market's doing, right? But it doesn't really have anything to do with their underlying earnings, okay? Difference between per share values may be due to, yeah. These are the things, these are the differences in between that book value and that market value that I'm talking about. Growth is one of the main ones. Okay. There's just some examples. We'll look at some real-time ones maybe. Cash flow is big, right? Again, because there's some limitations on the income statement based on some of those accrual versus cash accounting things and whatnot. Cash always, that tells you what you got for cash, right? How much cash you're producing and how much you're generating, and that can be a good thing to look at. Free cash flow is always wonderful, almost always wonderful, right? Getting back to some disadvantages of that accrual method is that it doesn't give adequate attention to that, the cash that's being generated. Again, you might be accruing some expenses or some of those other things, and yet you're still generating a lot of cash. Okay. Statement of cash flows, they break it down into from three different areas. Your operating activities, that means generally your sales, your gross profit, minus your expenses. Then what do we have, right? We got some cash that we're generating from that. Investing activities would be, are we selling some assets maybe and bringing cash in, or are we borrowing some money and bringing cash in? Okay, that can be invested, or I'm sorry, selling, because financing activities is borrowing money, or issuing stock, I'm sorry, or buying back stock, right, or paying dividends would be the financing. So investing activities or things like that, are you buying equipment, or maybe are you selling some old equipment, that type of stuff. Sorry, I got a little off there. Then you, yeah, compute the net changes in cash flow. And I'm kind of whipping through some of this because I want to get through it, get you guys going on your homework a little bit, so. Kind of talked about that a little bit. You guys will be doing some of that. Actually, kind of reminds me of a joke, but it's basically the same premise. Guy goes and applies for a job as an accountant for a company, and they sit him down for the interview, and they say, okay, we've only got one question. And he goes, okay. And they go, well, what's 3 times 6? He thinks about it for a second. He goes, 20. They go, thank you. And so he leaves, and as he's walking home, then he realizes, oh crap, he got the answer wrong, you know. But he's walking along, and his phone rings, and it's the company, and they say, we'd like to hire you. He says, you want to hire me? He says, but I know now that I got that question wrong. And the guy says, yeah, but you were the closest. Yeah, I kind of talked about investing activities. Financial activities can be issuing bonds, stock, other securities, which aren't too common. Paying dividends, buying back stock too would be another thing that happens here. There it is, talks about that there. Things that you look at when we're analyzing companies, that's right. You know, how are increases in current assets being financed, if they're being financed? It could be that we're just generating cash, you know. Apple you know, they keep building up their current assets because they generate a lot of cash, billions of dollars of cash every single quarter, right? So does Microsoft. You know, a lot of these companies, Google builds a lot of cash too, right? Is there associated buildup in current liabilities? You know, not so much in their case, that's for sure. But in other companies, it can be. You could get huge, for example, you could get a huge increase in accounts receivable because you've been selling a lot of stuff, that's good, but you gotta finance that too maybe. So you might be borrowing money from the bank over here to finance that because you need to, because you had to build up those inventories that you sold that became accounts receivable. You know, that can be a good thing, but it can also get a little bit carried away too, so. And then how are increases in long-term assets being financed? One of the important things here, you know, we talked about this in banking from day one. I think the first day I was ever on the job, they says, you always match up your lending to the asset. In other words, you don't give somebody a 10-year loan to finance their inventory, right? Inventory is a current asset. It's got to be turned over within a year. So you give them no more than a 1-year loan if you're financing inventory. Doesn't mean you won't roll it over at the end of the year. You know, if they're doing a really good job, you might roll that over. But the term of that loan is 1 year, and that's so you can reanalyze it, okay? You also don't finance a $500,000 combine on a 1-year note. Okay, that doesn't make any sense either, that you're gonna expect the farmer to pay that off. There were some exceptions to that one, because you get some farmers that could pay it off in 1 year maybe, but for the most part, you know, how long is a combine gonna last? You know, maybe from 7 to 10 years in today's day and age, right, that it would still have value, and so you'd finance it over that kind of a term. Depreciation, we'll do some exercises about depreciation, I think fairly early on, chapter 3, chapter 4, okay? Again, it's kind of considered a non-cash expense. Accounting rules right now are allowing companies to, instead of depreciating things, fully write them off. I gotta look that up a little bit too, because I'm not 100% clear on that rule change. Probably because I haven't been trying to keep up as much as I used to, but instead of buying a piece of equipment for $100,000 and writing it off over 10 years, meaning that you depreciate it or you get a $10,000 a year write-off, real simplistic way of looking at depreciation, they can write off that full $100,000 in that first year, okay? And that can be very advantageous. Generally, I think they have the choice. So if you didn't have a lot of income, if you bought that piece of equipment and you didn't have a lot of income, you might not want to write that off in that first year. You might want to go ahead and depreciate it, right? Okay. But if if you write it all off in that first year and you show a big loss anyways, you get to carry forward that loss to future years too, right? In accounting practices, okay, in tax practices. Cash flow, yeah, big thing, and it gives you, again, you can pay dividends, you can buy back stock, you can do lots of things for that. With that, they talked about leverage buyouts. Corporate tax rates, this change took place, I think, to 21% in 2018, if I'm not mistaken. Corporate tax rates were higher than that, I think they're 28%. Okay, there's some talk about maybe raising them back up again. We'll see. Yeah, this created all kinds of weird looks to financial statements. I mean, I think the net effect of this was pretty positive in terms of obviously income for corporations and whatnot, but boy, we had some weird looking things, and it had to do with those accrual of expenses. Remember I was giving you that example about like a car company, and they know that they're gonna have recalls that are gonna equal 5% of the sales of their cars, and so they take that in that first year, right, from the SEC standpoint, but not on the IRS, okay? I gotta figure out how that works. It gave them, though, an advantage. I gotta go back and try to remember. In any event, when the tax rate came down, the future advantage of that was less because the tax rates were gonna be less versus greater, if that makes sense. You were gonna have less of a write-off in the future is what it amounts to than what you had when the tax rates were higher. Kind of very confusing. It's kind of like interest, right? Interest is a tax deductible expense, okay? And so when tax rates are high, that interest expense is kind of nice. You get to write off that interest expense, right? As tax rates get lower, it becomes a little less advantageous. And that was kind of similar to the tax thing I was telling you about with the cars and stuff. I have to sit down and pencil that one out. That might be done here. Oh, depreciation is a tax shield, yep. There we go. All right, let's jump into now. Let's take a look at what you guys got coming up, because I think your assignment's due Thursday, isn't it? Yeah. First volleyball right this weekend. We got volleyball tournament going on here in town. I think they play Friday at noon against Mayville State. And I've never heard of Presentation College. Where's Never heard of them. And then they play again on Saturday versus Valley State at 11 a.m. and 3:30 versus Dickinson State. Those two I've heard of before. Mayville I've heard of before. And then, but I've never heard of Presentation College. That's kind of neat. Oh, they are. Okay. Okay. Mayville is over in Minnesota, I think. Yeah. Yeah. You guys wouldn't remember this. You got to be really, really old to remember this. But Disney made some movies, old movies. I think they were even black and white. I think Flubber and Son of Flubber. There's been a new Flubber that was out not too long ago. But and the football team at the college, was it Mayfield? I think it was Mayfield College and not Mayville College. But they were always really lousy. But they got Flubber, and then all of a sudden they became really good and whatnot. They're kind of cute movies, but I was confused. When I first saw this Mayville State, I thought that was maybe like Mayfield or whatever, so. By the way, it's supposed to be 101 degrees tomorrow. I know you guys are all looking forward to that. Okay, so here's where you're gonna be, right? Week 2, you got your chapter 2 quiz. It's due tomorrow. Tomorrow night, is that tomorrow? Yep, September 7th. So, okay, we kind of went over some of that. Again, it's open book. You got until tomorrow night to do it. You don't have a time limit on it, so that's fine. You'll have a chapter 3 quiz due. That one's due Wednesday. No, that's Thursday, right? Yeah. Okay. Thursday at 3, and also your assignment will be due at 3 o'clock by then, okay? That's just, yeah, 3 p.m. I don't know, seemed like a good time. Yeah, well, then you get it done Tuesday. Huh? We'll see. I don't know why I picked 3, but I may change it, but don't count on it. Cool. Ooh, okay, we'll talk about that. Those are pretty simple, so. Okay, let's take a look at the assignment kind of. So you click on this, the Excel spreadsheet is where the actual assignment appears, right? Okay, so you click the down arrow, you download it, so it opens up then the Excel spreadsheet, okay? You do have to hit enable editing. You'll note that I've kind of already got it set up. Not gonna let me enable editing. Come on. Do anything. There we go. Okay. I've already got it set up. You know, just do your homework right using the Excel spreadsheet. So you got problem 3.2 is the first one here. Okay, problem 3.3, problem 3.4. So you got all kinds of room just right down below it, so you can do your work down there. There's a lot of these problems on this first one. I don't know a lot of them, but several of them anyhow, where you're really kind of trying to figure out. They're giving you enough information to force you to figure out what's the company's assets, right? Let me look at some of these problems and give you a good example. Here, right here. Nope, that's not the one I was thinking of. Okay, so polyester dress shops can open a new store that will do annual sales volume of 760,700. It will turn over its assets 1.9 times per year. The profit margin on sales will be 8%, but we got to figure out what the return on assets is, right? So we got to figure out what the company's assets are. I can tell you the math here is pretty simple, but you just got to think it through sometimes, right? So let me give you a real basic example and have you take it from there. So if a company had assets or had sales of $100,000 and it turned its assets over 2 times, okay, what does that mean its assets were? Just the opposite. Go the other way. 50,000, right? Okay, so if a company has sales of 100,000, okay, let me just put it on here so you guys can see it. So we got the sales, right, 100,000. Good. Oh, man. Okay. And its asset turnover is 2, right? So what are its assets then? Okay, this means that it's turning its assets over twice in the course of the year, right? So what's its assets? That's pretty simple, right? This should be equal to this divided by that, 50,000. So the company has total assets of $50,000. Okay. Again, the math on a lot of these is real simple. It's just trying to get you to think through, you know, the various components of a balance sheet or an income statement or those types of things, right? Okay. And some of it has to do with the terminology, you know, that we just went through. Understanding maybe the difference between net income, gross profit margin versus profit margin, right? Gross profit margin is sales, cost of goods sold. We've got gross profit, right? Gross profit divided by sales gives us our gross profit margin, okay? Profit margin is we get down to our net income and we divide that by sales, and that gives us our profit margin, okay? Kind of a different thing. So let's take a look at number 1, see if there's anything kind of weird about that. Let me just say a couple things in general. Take your time with these and set them up, kind of like I just did, okay? You know, set them up, make it look nice. Yeah, that makes it a little easier for me to correct. But I think you'll find that if you get in that habit of setting these problems up, you'll be able to see yourself sometimes if you make a mistake, okay? And it takes you a little bit longer, yeah, but trust me, it'll pay off in the end. And then and believe me, I'm one of those guys that I like to take a shortcut for everything. But I've kind of learned that when it comes to accounting and finance, a lot of times it's easier to just go ahead and put it down, set it down, write it out, type it out, whatever, set up the problem, okay? Use the information that I have and set it up properly and then do it. And then the other thing is, it's a rule I have for myself is, does it make sense? Does the answer make sense? So take a look at the answer when you get to it, and oftentimes you can kind of look at it and, we'll do some problems later. It's an easier example of like payments, okay? We'll show you how to figure out payments on something. If you got a car loan, you got an interest rate, boom. So give you an example. Let's say you had a car loan for $25,000 and it was going to be over 5 years, okay? And you came up with a payment when you got all finished that was $1,000 a month. Do you think that'd be realistic? Well, no, because you got 60 months times 1,000. All of a sudden, you're paying back $60,000 on a $25,000 car loan. Nah, it's not right. Okay, and so sometimes just some simple math like that, that your payment is going to over that 5 years is going to be greater than the 25,000 because you got some interest, right? Interest rates right now are 5 or 6%. So your total payback ought to be maybe around 30 grand or something, right? Give or take a couple grand. I mean, I'm just really throwing some stuff off the top of my head there. So if it's 30 grand, you had 60 payments, maybe my payment's going to be about $500 a month or something, right? Okay. Again, I might be $25 off either way or $30 off either way, but at least I'm in that ballpark, right? And so if you do some of those ballpark things like that and you think it through, that'll really help you, okay? Take a look at your final answer and say, does that answer really make sense, okay? Because oftentimes I'll get some answers, and I kind of look at them, how'd you ever come up with that, and why couldn't you tell, that was way off base. So, okay, anyhow, taking a look at like number one, database considering expansion, new product line, assets to support expansion, going to be $420,000. So that's our investment. Okay, is estimated that database can generate 1.560 in annual sales with a 6% profit margin. Okay, so profit margin, that's net income. So now what do we got? We got to figure out what would net income. So we want two answers here. So first we got to figure out what's our net income, right? That's pretty simple, right? If I got 100,000 in sales and my profit margin is 10%, what's my net income?
I'm sorry.
Okay.
I'm really skewed today.
Okay.
So start over and talk a little slower.
Okay.
Because I don't see what the numbers were in the
Okay, so let's say, I'm just giving you an example. Let's say I got 100,000 in sales, right? Profit margin is at 10%. Oops, let's just do it this way. Okay, so then what's my net income? 10,000, right? This times this then.
Yeah, so we can follow the book that.
Well, it's your guys' homework.
Does it show us how to do that in the book? Does it walk us through that step by step?
Probably, and that's number one, but number two, I've done a video that'll walk you through it step by step. Exactly. Yeah, it'll walk you through it step by step, just exactly each problem, okay? Oh, yeah, yeah, yeah. And these first few chapters, it should help you a lot. We'll get into some stuff that's a little more gnarly, okay? PT, yeah. But it's good stuff, and again, Excel does so much of the workforce nowadays that it's to me, it's just a lot of fun, so. Okay, so now if I'm making $10,000, then if, whatever my assets happen to be, right, let's say my assets are 50,000, kind of back to our other problem, right, then what's my return on assets? Well, let me do this, so equals, right, this times this, okay, so my net income is 10,000, so my return on assets, okay, in this case, right, the problem here is 420,000, but my little example down here, I'm gonna say my assets were 50,000. I haven't set this up in the order that I probably would, but. So now what's my ROA? Just equal to my profit, right, divided by my assets. Or 20%, right? And if you put it in a decimal thing, that's fine, I can figure that out, but if you wanna go up and just click it and make it a percentage, cause that's what it's asking for, that's pretty simple to do too, right? Okay. And it's asking for, well, return, normally we'd put those in percent. Again, decimals are fine. And, you know, they get it a little bit confusing here because they're talking about investing in maybe a piece of equipment or something. But it's, so it's your return on that piece of equipment or your investment in that piece of equipment, yeah. Versus when you're looking at a whole financial statement, it's the whole assets that are out there, so, yeah, exactly. Okay, let me go show you. I just wanted to show you guys that, the videos again. If you get down, you're on week 2, okay? If you scroll down, there's a whole separate section for the videos. Okay. If you just click on them, it'll open it up right in the browser.
My name is Ariel, and I just started my first job as a project
Sorry,
manager. When I
You
was
gotta
a
listen to
student,
the
I
ad
write
until
long
you can hit the
essays
skip
that
ad.
Business Finance, Chapter 3, Problem 2, related to Problem 2. I think I've done Problem 1 as a little bit of an example, just to give you a quick background on this. Problem 1, just to look at it, all we're calculating here is return on sales or profit margin. I'm sorry, this should be called profit margin, although I would call it return on sales as well.
Enough.
And it's simply taking profit, or sometimes we'll end up calling that net income, and dividing it by.
Yeah, you guys will have some class time. Yep, absolutely. Yeah, in fact, pretty much the whole class on Thursday should be dedicated to that, so, yeah. So that's kind of why I did the 3 o'clock thing, because you guys should have it done by class, I would think, right? Okay. If not, you know, you can holler at me or something. Yeah, and then I'll be here if you got questions, you know, we'll be here working on them, or your classmates can help you, whatever, okay? That's the idea, is that everybody gets this, not that we worry about, you know, me dinging you because you got something a little bit wrong or right or something, so, okay? And you're gonna have some time yet today here to work on this a little bit too. So you got your chapter 2, you got your chapter 3 quiz. The other question was, and they're due? Dang. Okay, pick a company, okay, and that's simply for project 1. I kind of walked you guys through project 1 a little bit and said that what you're gonna do is all the financial statements basically for that project. So all I want you to do by Thursday is say, I wanna do a lawn mowing company. Okay, boom, you're done, okay? I wanna do a snow removal company. I want, you know, whatever it is that you've chosen. And again, keep it simple, right? Keep it simple. There's gonna be a couple requirements. I think I said I want you to show you're gonna have at least 1 part-time employee or, you know, full-time. You're gonna borrow a little bit of money, because I want you guys to see how that shows up on the financial statements. But we can do that with any company, right? I mean, we can figure out a way that you gotta borrow a little money or something, so that's not a problem, okay? So that's all there is to that assignment. That shouldn't take you any more than a couple minutes. If you got questions about a certain company that you're thinking of, just holler at me, and you can type that right into the, you know, the browser space. You don't have to put it on a separate Word doc. You know what I'm talking about when you're submitting those types of assignments in Brightspace, and you can just type your answer right there. That's good enough.
It still makes you submit a file with it though.
Does it?
Yeah, you can't just submit a text box, you have to have a file.
I guess put in a Word doc then. I thought you could just type it in there. God, that's kind of
how it was
crazy.
in our old system.
Okay.
I apologize, yeah.
Yeah. Well, we can, when I'm done here, and I'm just about done, then we can check it out. If one of you guys wants to get into it and take a look at it, we can do that and see if you can just type it in there, so. And the couple quizzes, again, some due today, right? Tomorrow? Yep. And then the others due on Thursday, so. Okay, any questions? I'll quit talking then, let you guys get busy. Call.
Is there much of a lecture for Saturday?
Nope, nope. Won't be any real lecture. I might glance at it, and if there's a little terminology or something, you know, I might spend 5 minutes, 10 minutes at the most at the start of class, and then I'll give you guys the rest of the class period to work on stuff. that's why I said, this class will mostly be flipped. From now on, the first couple chapters, yeah, I want to talk about some of that stuff. We get to the very end, and there's another chapter where I'll probably force you guys to listen to me for a little bit, but other than that, you guys will have a lot of time to work on stuff, so. Some of them I'll take a little more time to show you some of the things on Excel maybe, but other than that. Okay, I'm gonna shut this off, and you guys can go to work on those things that you want to. Somebody, bring up the Brightspace thing on the submission thing, okay? Let me get this stopped.